John, obviously you're head of EMEA offices. How do you see the European outlook as we go into 2020 for the office sector?
Well, people often talk about EMEA as one market, and clearly there are lots of markets that operate within it, and different countries we've seen have benefited from the fiscal and monetary policies that we've seen in different ways. And I would say if you look at Germany and France, for instance, there's been a lot of capital been going into Paris and the 5 principal cities in Germany, driving yields down to levels which we have not seen before. If you compare that, however, with some of the other parts of Europe, which have been held back, in my view, so Milan, for instance, for political reasons, Madrid is behind in the cycle, therefore, compared to its previous peak, is only just getting ahead of where it was before. And of course, London. So London, through Brexit, has seen muted levels of transactional volume, in my view, due to the hiatus that's been created between the sellers and the buyers. And I think that's not a lack of capital, it's just a point where those two ends of the deal, nobody wants to blink today because they felt there was a short-term resolution to that point, either through Brexit negotiations or through a new election. So I think actually there are very different, distinct characteristics throughout EMEA, and one thing we look to do is to try to choose the right country to invest in at the right moment, of course.
And interestingly, it seems as though occupiers are in general influencing significantly both office design but also the investment cycle. What are you seeing from the occupier side?
From the occupier perspective, something which is really apparent to me is despite the very low levels of availability, occupiers are increasingly discerning. They want the very best space, and in order to get that space they are prepared to pay a little more. They're more demanding of their landlords, but they're also prepared to occupy it in a more dense way, so more people on the floor plate, enabling them to pay more. Occupiers now really value being on one level. I think the improved collaboration of your own workforce being based on a single level is properly recognised. As a result of that, I think occupiers now value being on a single floor much more than having their own building. So from our perspective, buying bigger buildings with floor plates that can accommodate a whole business, and for you to provide some of those amenities that might be shared by 3, 4 or more businesses in the same building, i.e. conference space, those kinds of things can be very valuable, and also if they're used in the right way, in fact you don't even have to attribute any rental to that space because actually the payback is throughout the building, and occupiers are certainly choosing buildings which have a higher degree of amenity, and therefore the payback is in shorter voids and potentially higher rents.
And location has always been the view. Do you think that's still the case, both for the occupiers but also then the investors?
Yeah, I think there's definitely a very strong desire to be in the very best locations. I think you can't overestimate the importance of traditional locations well connected through infrastructure, but there are also new areas developing, and certainly types of occupiers that are clustering together to form new sub-markets. And from my perspective, when we look at these, we try to identify the ones which are truly long-term, where the sub-market is being formed and has a real long-term horizon, and not something where if and when the tide goes out, it becomes the area where the vacancy levels rise. So we're very careful and disciplined, I would say, in trying to choose those truly long-term locations for new occupiers.
And in terms of ESG, obviously for investors, one of the key issues has been how do you get the return on investment from that? But do you see that as that kind of changing now?
Yeah, I think there's two things. Occupiers are now prepared to say, look, I want this building to improve, and they will work in partnership with the owner, and they're open to the idea of capital investment being provided by the owner, and for them to pay potentially an increased rent or to increase the length of their lease, etc., to commit to the building. So I think that's very helpful, obviously from investors' point of view and trying to get a return. The second thing that I think is really fundamentally changing is the cost of those improvements is reducing all the time. So I would say that 5 years ago, there was a real fear and a kind of a suspicion about investment that was put into buildings and whether there was really any tangible payback. It's very measurable now, and I think that with increasing costs of energy, for instance, you can find alterations to a building with a payback as low as 3 years. Now, typically leases in most parts of Europe are 3 years plus, and therefore occupiers are very happy to contribute, if not actually pay for those changes, because the payback entirely falls to them.
And in terms of, I suppose, the investment strategy, you've got to think about not just what occupiers are looking for today, but also what they're looking for in the future and analysing those trends. So I suppose, what sort of buildings are you looking for and what kind of locations?
So the kind of buildings we look for me, we're at a point in the cycle where yields are obviously very low by historic standards. Rents have typically, in most markets, grown to way beyond their previous peaks. And therefore we're looking for buildings where we can use our own skills and invest capital effectively to drive some performance. So we are looking for buildings where they may not be perfect today, but actually are capable of becoming real gems. And I think that's, for us, that seems to be the most appropriate investment strategy at this point in the cycle.
Great. I think it'll be a really interesting year, 2020, in terms of watching these developments for the office market, particularly here in London. So thank you, John.
Yeah, thank you.